ACC 212, Study Session 1, Definition and Nature of Public Sector Accounting. Introduction. It is important you know that the first step in approaching public sector accounting as a subject is to understand the meaning of the term public sector accounting. Public sector accounting is an aspect of accounting. Having understood the meaning of public sector accounting, the second step in understanding the subject matter is being able to describe the major components making up the public sector. In this study session, you will learn public sector and the nature of the public sector. Public sector accounting. Public sector accounting is an aspect of accounting. It covers accounting in government ministries and extra-ministerial departments, either at federal or state levels, local governments, government parastatals, government committees, task forces, and commissions amongst others. The above definition simply means public sector accounting encompasses accounting in core government establishments, ministries, extra-ministerial departments, and local governments, and government parastatals, for example University of Benin, agencies, for example Flood Control, and commissions, for example Economic and Financial Crimes Commission, EFCC. Having understood the meaning of public sector accounting, the second step in understanding the subject matter is being able to describe the major components making up the public sector. This is very important because before you can embark on giving accounting treatment to any financial transaction in any organization, you must first and foremost understand the nature of the organization. The nature of the public sector. Public sector accounting is akin to government accounting, but the difference lies in its scope. Government accounting covers only accounting in ministries, extra-ministerial departments of government, and local governments, while public sector accounting is broader because it encompasses government accounting and accounting in government parastatals, committees/task forces, and commissions. Summary of Study Session 1. In Study Session 1, please note the following. 1. Public sector accounting is an aspect of accounting. It covers accounting in government ministries and extra-ministerial departments, either at federal or state levels, local governments, government parastatals, government committees, task forces, and commissions amongst others. 2. Public sector accounting is very important because before you can embark on giving accounting treatment to any financial transaction in any organization, you must first and foremost understand the nature of the organization. 3. Public sector accounting is akin to government accounting, but the difference lies in its scope. 4. Government accounting covers only accounting in ministries, extra-ministerial departments of government, and local governments. 5. Public sector accounting is broader because it encompasses government accounting and accounting in government parastatals, committees/task forces, and commissions. Study Session 2. Constitutional, Legislative and Regulatory Context of Public Sector Accounting. Introduction. In this unit, you will learn about the constitutional provisions on revenue, the constitutional provisions on revenue allocation, and the constitutional provisions on public expenditure, legislative context of public sector accounting, including the Annual Appropriation Acts, the Finance, Management and Control Act, 1958 and the Audit Ordinance, 1956, and the regulatory context of public sector accounting. The constitutional provisions. The constitutional provisions as to public sector accounting can be explained from three perspectives, viz. A. The constitutional provisions on revenue. B. The constitutional provisions on revenue allocation, and C. The constitutional provisions on public expenditure. 1. The constitutional provisions on revenue. Revenue simply means any income or returns accruing to or derived by the government from any source. This includes A. Any receipt, however described, arising from the operation of any law. B. Any return, however described, arising from or in respect of any property held by the government, and C. Any return by way of interest on loans and dividends in respect of shares or interest held by the government in any company or statutory body. In line with Section 162(1) of the Federal Republic of Nigeria Constitution, the Federation shall maintain a special account to be called the Federation Account, with which shall be paid all revenues collected by the government of the Federation, except the proceeds from the personal income tax of the personnel of 1. The Armed Forces of the Federation. 2. The Nigerian Police Force. 3. The Ministry or Department of Government charged with responsibility for foreign affairs. 4. The residents of the Federal Capital Territory, Abuja. All revenues raised or received by the state governments, for example Delta State Government, shall be paid into the respective state's Consolidated Revenue Fund, CRF. 2. The constitutional provisions on revenue allocation. The President, upon the receipt of advice from the Revenue Mobilization Allocation and Fiscal Commission, shall table before the National Assembly proposals for revenue allocation from the Federation account. It should be noted that the amount standing to the credit of local government councils in the Federation account shall be allocated to the states for the benefit of their local government councils on such terms and in such manner, as may be prescribed by the National Assembly. Likewise, any amount standing to the credit of the judiciary in the Federation account shall be paid directly to the National Judicial Council for disbursement to the heads of courts established for the Federation and the states under Section 6 of the Nigeria 1999 Constitution. 3. The constitutional provisions on public expenditure. No money is allowed to be withdrawn from the Consolidated Revenue Fund of the Federation except to meet expenditure that is charged upon the fund by the Constitution, or where the issue of those monies has been authorized by an Appropriation Act, Supplementary Appropriation Act, or an act passed in pursuance of Section 81 of the 1999 Constitution of the Federal Republic of Nigeria. In respect of any financial year, it is found that a. The amount appropriated by the Appropriation Act of any purpose is insufficient, or b. A need has arisen for expenditure for a purpose for which no amount has been appropriated by the Act. A supplementary estimate showing the sums required shall be laid before each House of the National Assembly and the heads of any such expenditure shall be included in a supplementary appropriation bill. The legislative context of public sector accounting. As earlier stated under Section 1.1, the legislative context of public sector accounting has to do with the process of lawmaking and passing laws as they relate to accounting in the public sector. The laws passed become acts of Parliament. These acts include 1. The Annual Appropriation Act. 2. The Finance, Management and Control Act, and 3. The Audit Ordinance. 1. The Annual Appropriation Act. The Annual Appropriation Act is an annual act of the legislature, which authorizes and controls the receipt and payment of public funds. It also establishes the legal basis for the collection of all government receipts and the disbursement of public funds for various authorized purposes. In other words, the Annual Appropriation Act serves the purpose to authorize and control the receipt of government funds. 2. The Finance, Management and Control Act, 1958. This act came into operation on the 31st of July, 1958, and was to provide for the control and management of public finances of the Federation and for matters associated with it. It consists of six parts viz. Part 1, deals with general supervision and control of public funds. Part 2, deals with all relevant provisions connected with the Consolidated Revenue Fund. Part 3, deals with investments. Part 4, deals with legislative authorization of expenditure. Part 5, provides for the establishment of other public funds of the Federation established with effect from 1st of April 1958. 3. The Audit Ordinance, 1956. This act provides guidelines for the audit of government accounts and empowers the Auditor General to audit the account of the government. He is to examine and audit all the accounts of the government and transmit copies of the account alongside the certificate of audit and report upon the examination of all accounts relative to the public fund to the Minister of Finance. Section 13, 14, and 15 of the Act provides that, the accounts to be signed and presented by the Accountant General to the Auditor General are to include the following. 1. An abstract account of receipt and payment. 2. A statement of assets and liabilities at the close of the financial year, and 3. A detailed statement of revenue and expenditure arrangement according to subheads. 2. Regulatory context of public sector accounting. The power to control accounting in the public sector in order to ensure the public sector is operating fairly is contained in 1. The Government Financial Regulation. Only the federal and state governments make use of the Government Financial Regulation in the public sector. Besides the issue of financial regulation, a lot of machinery like financial control institutions and other agencies of government have been put in place to ensure compliance with the regulation in all aspects of the public sector including the ministries/extra-ministerial departments, parastatals, and government agencies. The states and local governments are not left out as standard financial institutions and memoranda has also been issued to regulate the financial activities in all its departments. The Government Financial Regulation and memoranda are readily available in premises of high courts in Nigeria. You are advised to go and pick a copy for review. It should be noted that these accounting guides, as they may be called, are made up of 37 chapters in the case of financial regulations. 2. Financial memoranda for local government. The financial memorandum is the government financial regulation applicable to the local governments. It refers to the laws, rules, and policies meant to ensure that public funds and resources of local governments are deployed to meaningful developmental purposes. The local government financial memoranda, having no constitutional provisions, however, has as its regulatory framework on local government staff regulations, public service rules, finance circulars issued by the state, Decree No. 21 of 1999. Basically, the financial memoranda consist of guidelines on preparation and management of 1. Cash book. 2. Expenditure control. 3. Statement of assets and liabilities, and 4. Local government annual estimates. Summary of Study Session 2. In Study Session 2, please note the following. 1. The constitutional provisions as to public sector accounting can be explained from 3 perspectives, viz. A. The constitutional provisions on revenue. B. The constitutional provisions on revenue allocation, and C. The constitutional provisions on public expenditure. 2. The legislative context of public sector accounting has to do with the process of lawmaking and passing laws as they relate to accounting in the public sector. The laws passed become acts of Parliament. These acts include A. The Annual Appropriation Act. B. The Finance, Management and Control Act, and C. The Audit Ordinance. 3. The power to control accounting in the public sector in order to ensure the public sector is operating fairly is contained in A. The Government Financial Regulation, and Financial Memoranda for Local Government. Study Session 3, Differences between Public Sector Accounting and Government Accounting. Introduction. This study session is prepared to give you an inside view of some aspects of accounting such as government and public sector accounting. It will also expose you to various organs or units of government made up of federal government and extra-ministerial department, state government and extra-ministerial department, local government, government parastatals, committees, task forces, commission, etc. Definition of public sector accounting. Public sector accounting is the process of recording, analyzing, classifying, summarizing, communicating, and interpreting financial information about government units and agencies in aggregate and detail. Having an overview of this definition, it is just the same as the universally accepted definition of financial accounting, therefore, making the public sector essentially financial accounting. Government accounting. This is an aspect or rather a subset of public sector accounting despite the fact that most of the languages, principles, basis, and tools used by the public sectors are borrowed from government accounting. Government accounting basically covers accounting for government ministries and extra-ministerial departments and local government organs of government. As you can see, we have used some terms in the course of explaining the public sector accounting and government accounting, especially in the aspect of their areas of coverage. These terms, which are the various organs of government, include 1. Federal government ministries and extra-ministerial departments. 2. State government ministries and extra-ministerial departments. 3. Local government. 4. Government parastatals. 5. Government committee. 6. Task force. 7. Commission, etc. Federal government ministries and extra-ministerial departments. This is an organ of government through which the federal governments render services to the public. They are set up to act as a check on possible excesses on government ministries. The departmental setup is headed by career officers. A good example of the federal government ministries and extra-ministerial departments are the Office of the Auditor General of the Federation, the Civil Service Commission, and the Federal Judiciary, among others. State government ministries and extra-ministerial departments. This is in line with what has been discussed above regarding federal government ministries and extra-ministerial departments, except in a few areas that border on the executive legislative list of the Constitution of the Federal Republic of Nigeria. Local government. This is the level of government which is closest to the people. It is also referred to as the grassroots level of government. In Nigeria today, where there are 774 local government areas, a uniform accounting system is practiced by all the local government areas. Government parastatals. The concept of parastatal is practically used to refer to organizations in which government has controlling shares, as well as government boards, corporations, and other similar bodies established by the individual and distinct status of the government. Examples of government parastatal at the federal and state level in Nigeria include Nigeria Port Authority, National University Commission, State Urban Water Boards, State Broadcasting Services, among others. Government Committee, Task Forces, and Commission. These are organs of government set up for a short duration to discharge some specific responsibilities and thereafter are dissolved on the completion of the assignment. Just like the parastatals, these committees are represented at the federal, state, and local government levels. Examples of government committees are state and local government task forces on petroleum matters, state and federal government committees on inquiring, and so on. Public sector accounting and government accounting. It is usually very difficult to differentiate between public sector accounting and government accounting because they are essentially the same. Some writers use the terms public sector and government accounting interchangeably. However, for the purpose of this study, you will get to know that the major difference between public sector accounting and government accounting is in their scope as discussed hereunder. Summary of Study Session 3. In Study Session 3, please note the following. 1. Public sector accounting and government accounting are essentially the same. 2. Their definitions are derived from the universally accepted definition of financial accounting, which states that it is the recording, analyzing, classifying, summarizing, communicating, and interpreting financial information. 3. Their focus is basically on government. No wonder the terms are being used interchangeably. The major difference between public sector accounting and government accounting is in their scope, i.e. area of coverage. 4. There are various organs of government, namely federal and state extra-ministerial departments, local government, government parastatal, committee/task force, commission, etc. Study Session 4, Accounting Concepts, Basis, and Principles in Government and Public Sector Accounting. Introduction. You need to appreciate the concepts, principles, and basis, which guide government and public sector accounting. To this end, you will be exposed to accounting concepts, accounting principles as well as accounting bases. It is expected that at the end of the session, you will be able to demonstrate the learning points both in practice and in theory. Accounting concepts and the variety of such concepts in government, accounting principles, and the principles that are used in government shall be duly discussed. Accounting concepts. Accounting concepts have been defined as the building blocks that underpin the preparation of financial statements. They are the broad basic assumptions, which underlie the preparation of the financial statement of an enterprise. In the public sector, they also refer to the assumptions on which the government's account and associated financial statements. The government's accounts and associated finance statements are prepared. 1. Entity concept. This concept plays out in the public sector organization, seeming public sector organization as a legal entity that is distinct and separates its stakeholders. 2. Going concern concept. This concept assumes that the government or its organ is expected to exist in perpetuity without any threat of curtailment. This assumption supports the notion of continuity in government even when the financial year, or fiscal year, of government ends on the 31st December of the year without the passage of a new budget. 3. Periodicity. The worth or value of government on its organ cannot be determined with precision, hence the need to divide the perpetual government or its organs into the fiscal periods. This would no doubt assist to appreciate the financial operating results and financed position of government for a period. Government and its entities have a fiscal period of 12 months beginning from 1st Jan to 31st of December. 4. Matching concept. This concept holds that in determining the results of financed performance or position, the earned revenue or income and all the cost of expenses that are incurred in generating the revenue should be matched. This concept becomes applicable in government business enterprises, GBES. 5. Historical cost concept. This holds that cost is appropriate for initial accounting recognition of all acquired assets, whether current or non-current, services rendered or received and expenses incurred, creditors or owners, interests. 6. Money measure. This concept recognizes the unit of measurement in the public sector in Nigeria in naira and kobo earn, just as any other territory will recognize the unit of measurement in that territory's currency. The principle and the fundamental assumption that follows this unit of measurement is the relative stability of the currency to permit comparative analysis between periods and to provide evidence of the financial dimension of rights and obligations resulting from legal contracts. Accounting principles. Accounting principles used by governments or their entities derived cash-based International Public Sector Accounting Standards, IPSAs, and with effect from 2016 from accrual-based IPSAs. However, such cash-based IPSAs is derived from experience. In the public sector, These principles reflect the way and manner in which finance statements will be prepared based on experience and belief. Essentially, these principles find expression in the following. 1. Materiality. This principle employs the criterion of significance. This suggests the possible effect of an accounting method proposed. It prescribes, for instance, that a particular accounting method preferred, say on grounds of convenience or economy, may be adopted only if it would not materially distort the results obtained or influence the decision that is based on such results. Now, 2009. 2. Conservatism/prudence. This principle is directly linked to the going concern. While going concern values may be used for closing assets, caution should be exercised in determining such values so that unrealistic profit figures are not disclosed, and in the event of all profits being withdrawn. 3. Consistency. A variety of ways of doing accounting work in government-related or private organizations exist, hence the difficulty in prescribing definite or specific rules or methods. Different organizations may have different rules at them disposed of. Such rules differ from the organization. The consistency principle is intended to avoid arbitrariness by the preparer of accounts. Accounting bases. There are 3 or 4 bases under which the financial statements of a public sector organization will be prepared. 1. The cash basis. This is the basis of accounting in which revenues are recorded only when cash is received and expenditures are recorded when cash is paid, and irrespective of the fact that transaction might have occurred in the previous accounting period. 2. Accrual basis. Using the accrual basis, revenue and expenses are recognized in the accounting period to which they relate and in which they are earned and incurred, and not when they are received or paid. The parastatals and GBES currently use the accrual basis, while government accounting is billed to commence accrual-based accounting from 2011 in fine with accrued-based IPSAS. On the other hand, cash basis allows for the following. 1. Easy to understand, at least, to non-accountants. 2. Non-existence of debtor and creditors. 3. Permits identification of those who authorize payments and collect revenues. 4. Allow for comparison between budgeted and actual. 5. Acquisition of non-current assets is written off. 6. Permission of delegation because of its simplicity. 7. Time saving. 8. Does not allow for the wholeness of financial transactions. 9. Cannot be used for economic decision-making and appraisal of the project. 10. Does not allow for computation of depreciation. 3. Commitment basis. This basis recognizes and records anticipated commitment or obligations at the boardroom when decisions are made. Such decisions may relate to making future payments when such payments are foreseen and not when the services related to the payment are rendered or the billings are received. Described in a similar way, the anticipated expenditure must be evidenced or supported by a contract of a purchase order as determined by the Board of Management. Commitment accounting can be A. Continuing commitments. Continuing commitments are those which require a series of payments actions to the contractor over an unspecified period of time. An example is the monthly payment of fixed charge of electricity whether consumed or not. B. Specific commitment. This type of commitment requires a specific or single payment or a definite series of payments over a specific time period. An example is a contract of goods and services. Budgetary basis. The public sector uses the budgetary basis as a means of deciding what is to be spent and generated for a period. The budget basis affords the government the means of deciding how much money is to be raised through the taxing power and other means and what is to be spent to increase the public good. The budget basis provides for the budget and the actual spending, leading to variance and the exercise, if need be, of control in the budgetary process. Summary of Study Session 4. In Study Session 4, please note the following. 1. Accounting concepts has been defined as the building blocks that underpin the preparation of financial statements. They are the broad basic assumptions, which underlie the preparation of the financial statement of an enterprise. 2. Accounting principles used by governments or their entities derived cash-based International Public Sector Accounting Standards, IPSAS, and with effect from 2016 from accrual-based IPSAS. However, such cash-based IPSAS is derived from experience. 3. The accounting bases used in public sector accounting include the cash accrual, commitment, and budgetary bases. The use of any base reflects the type of objects the enterprise carries out. Study Session 5, Bank Reconciliation Statement. Introduction. The word reconcile means to make compatible. It frequently happens in business that two sets of figures, which should agree, for some reason do not. For example, we might estimate that a certain profit should be made in a given period, but in fact, we fail to achieve this expected profit. A good accountant would seek to reconcile the two sets of figures, examining the reasons for the discrepancy. By reconciliation, the cash book balance can be proved by comparing it with the bank statement. Bank reconciliation statement is an important part of the internal control system over the cash balance lying in the bank. This study session is designed to give an insight into the bank reconciliation system in government. It will also expose you to the examination of causes of differences between cash book balance and bank balance. Meaning of bank reconciliation. Generally, payments and receipts recorded in the cash book are usually balanced at the end of the month to determine the net effect of payments and receipts for that month. It is usually recommended to check the balance of the cash book against the balance of the bank account according to the bank's recording of transactions for the month. Common reconciliations in a typical government setting. The following examples are common in the public sector organization and bank reconciliation. 1. Departmental vote reconciliation. This records the treasury records and the departmental vote account book. 2. Loan account reconciliation. This reconciles the book balance of the loan account of the creditor and the relevant book balance to eliminate the differences. 3. Service account reconciliation. This reconciles the actual consumption of service with the including statement produced by the provider of such a service. 4. Bank reconciliation. As observed above, this is the process of reconciling the bank balance of the organization with the cash position of the same organization with regard to the same transaction. 5. Cash reconciliation. This involves the process of reconciling the petty cash book balance with the main cash book. 6. Below the line items reconciliation. This reconciles the balances of the treasury with those of the ministries or departments. 7. Inward and outward current accounts reconciliation. This reconciles the balances of the Accountant General of the Federation's records and those of the various states' governments. Causes of differences between the cash book and the bank statement. The discrepancies in the cash book balance and bank statement balance can be traced to the following causes. 1. Unpresented checks. There are checks issued by the Treasury Cash Officer, which remains unpresented in the book as at the end of a given period. Checks, which remain in the hands of those to whom they are issued, are deemed stale and subsequently cancelled. A receipt is issued in favor of the cancelled checks. 2. Uncredited checks. These are checks that are received from other parties and reflected in the cash book bank column of the Treasury but yet to be credited in the bank or into the account of the relevant government's account with the bank. To this extent, the cash book bank column balance will be more than the balance in the bank statement by the amount of the uncredited checks. 3. Dishonored checks. These are checks received or issued by the Treasury as income or in settlement of a transaction and debited or credited to the organization's cash book. Such checks may not be honored by the bank for reasons, ranging from the irregular signature of the owner of the account on which the check is drawn, to account not funded or due to the wrong date, and so on. Bank balance will be greater or smaller than cash book balance as a result of the dishonored checks to the extent of the unpaid checks. 4. Standing order payment and receipts. These are payments made by the bank regularly on behalf of the Treasury on standing instructions to the bank. The Treasury only records the transaction when notified through debit or credit advice. To the extent that advice is not received before reconciliation is struck, there will be differences in the cash book balance and bank statement balance. 5. Bank charges. These are charges, which are imposed on the credit or debit balances in the bank statements, which are conveyed to the Treasury via appropriate debit advice. These charges are only reflected in the Treasury either on receipt of the bank statement or when debit advice is received from the bank. Summary of Study Session 5. In Study Session 5, please note the following. 1. Bank reconciliation, whether in the public or private sector organization, is the process of setting the discrepancy between the balances of the accounts maintained in respect of the same transaction at different points by different parties to the same transaction. 2. The following examples are common in the public sector organization and bank reconciliation. A. Departmental vote reconciliation. B. Loan account reconciliation. C. Service account reconciliation. D. Bank reconciliation. E. Cash reconciliation. F. Below the item accounts reconciliation. G. Inward and outward current account reconciliation. We shall examine a few of these to show how and what they stand for. 3. The discrepancies in the cash book balance and bank statement balance can be traced to the following causes. A. Unpresented checks. B. Uncredited checks. C. Dishonored checks. D. Standing order payment and receipts. E. Bank charges. Study Session 6, Fund Accounting. Introduction. Government accounting systems are organized and operated on a fund basis. A fund is a basic unit used to segregate resources, revenues, and expenditures in the Treasury. This study session is designed to give you an insight into some government departments and accounting for funds. It will also expose you to concepts and clarify some misconceptions. Meaning, concept of fund and funding principles. Government accounting systems has aptly been described as a separate fiscal and accounting entity with a self-balancing set of accounts recording cash and other financial resources, together with all related liabilities and residual equities or balances, and changes therein, which are segregated for the purpose of carrying on specific activities or attaining certain objectives in according with special regulations, restrictions or limitation. The public sector has diverse functions, multiplicity of responsibilities, and restrictions, which have made of responsibilities to areas of operation. This also allows the segregation of resources provided for specific purposes. The concept of the fund can be further or better understood when you view an organization as a series of funds such that each fund that is restricted to a particular area of operation, has specific assets and associated liabilities. Criteria for the existence/creation of a fund. The following criteria may be required and adjusted from time to time to justify the continued existence or even creation of a fund. 1. Revenues or expenditures of the activity must not fall below a particular threshold, say, in the case of the Sovereign National Wealth Fund, $1 billion or 150 billion naira, or naira equivalent. 2. Assets and liabilities will well continue beyond a budget cycle or one financial year. 3. Many agencies' involvement in sourcing and applying fund sources. 4. There should be enough cash at the beginning to create the fund and to continue to fund it. 5. There should be constitutional or regulatory backing to support a new fund. Classification of funds. Funds are categorized by their types, which indicate both the sources of the fund's financial resources and the nature of activities financed. 3 broad categories or classifications of funds are used in governmental accounting. They include: 1. Government funds. These are funds that are used to account for resources, which are derived from the general tax and revenue powers of the government. Government funds are essential for most of the typical governmental functions. Such governmental function and responsibilities fund expression in the acquisition, use, and balances of the expendable financial resources and the related current liabilities, other than those accounted for in proprietary funds. 2. Proprietary funds. These are funds that are used to account for a government's ongoing organizations and activities that are similar to businesses found in the private sector. In these funds, resources accounted for are derived from the business activities of the government and its agencies and parastatals. In this sense, these funds are seen as self-supporting in that the services are rendered by them and financed through charges or costs imposed on users or consumers of such services. 3. Fiduciary funds. These are funds that are used to account for assets and other resources held and managed by a government unit in a trustee capacity or as an agent in governmental units. Types of funds. The following types of funds can be seen in the context of the broad categories of governmental, proprietary, and fiduciary funds. Generally, the following types can be distinguished. 1. General funds. This fund is used to account for all financial resources of the government not required to be accounted for in some other fund. This fund is devolved to financing the general administration of the government. The Consolidated Revenue Fund, CRF, is an example in point. 2. Capital Project Fund. This fund is used to accommodate capital project resources. These are financial resources that are assigned to the acquisition and construction of major capital projects. This fund is also known as the Development Fund, intended for capital expenditures. 3. Special Fund. This fund is created for a specific purpose. Examples include Insurgency Support Fund in Nigeria, South Africa, or Liberia Relief Fund, as it was, in South Africa or Liberia. 4. Trust Fund. This is a fund whose resources are held by the government as a trustee. The trust fund is only executed on terms spelled out in the trust deed. Examples include Tertiary Education Trust Fund, TET Fund. 5. Contingency Fund. This fund is used to account for financial resources met for unforeseen or anticipated expenditures. As the name suggests, this fund is met for contingencies or emergency situations. It is created by the Finance, Control and Management Act of 1958. 6. Agency Fund. This is a fund used to account for resources held by the government in a custodian capacity for other governments, private organizations, or individuals. 7. Revolving Fund. This is also known as a working capital fund. It is a fund that accounts for financial resources to take care of services provided by a designated unit to other departments within a single government setup. An example is a revolving loan fund. Sources of authority and justification of fund accounting. Funds are the products of legal instruments. They are created through legal means. The Constitution as amended, the Finance, Control and Management Act, 1958, and the Audit Ordinance, 1956 are the legal instrument that gave birth to Consolidated Revenue Fund, CRF, the Development Fund, the Contingency Funds, among others. The following, though not exhaustive, profiting the existence or creation of funds and consequently the need for fund accounting. 1. Diversify/multiplicity of government function and responsibilities. 2. Existence of authority that is not owned. 3. No shareholders whose view of business or organization reflects the proprietary or entity view. 4. Ability, through the instrumentality of the law, of government to collect, impose, tax. 5. Need for accountability for acquisition and disposition of funds, tax. 6. Satisfaction of service-based accounting system. 7. Control and flexibility in the size of a reporting unit. Weaknesses of fund accounting. Fund accounting is not a fix-all. Its operation has two main defects. Accounts are prepared on a cash basis, that is on the basis of receipts and payment without an attempt to accrue for items of receipt or expenditure earned or incurred. It is however expected that the adoption of accrual-based IPS is the international public sector standard by the public sector organization. Emphasis will begin to shift. Non-recognition of assets and liabilities as recorded in the accounts and in line with accrual-based accounting. Assets acquired are charged at full cost without an attempt to write it off over its useful life. No capitalization or depreciation. Summary of Study Session 6. In Study Session 6, please note the following. 1. Fund accounting is a method of accounting for the resources of a government, given the number of resources at the disposal and the diversity of functions to be executed. 2. Such fund accounting is similar in operation to a private sector organization, which is similar to an area of operation of government where a fund is applied. The practical effects of fund accounting hinge on the extent to which different funds are utilized and the form and extent to which the individual funds accounts are consolidated into one operating statement and a statement of financial position. Then the result might just be the same as the accounts of a business. Study Session 7, Self and Non-Self Accounting Units. Introduction. The system of recording transactions in government is expectedly meticulous because all receipts or payments must be vouched for on set-out forms. Accordingly, the financial regulation gives detailed guidelines of the payment procedure. Suffice it to say that the rules outlined in the various relevant sections of the financial regulation must be observed for payments on receipts to be valid. In this study session, you will learn about the concepts of self-accounting and non-self-accounting units in public sector accounting. Explicitly, you will be introduced to the conditions to be fulfilled before a government department may become self-accounting, the dimensions of self-accounting, sub-self-accounting units, and non-self-accounting units. Self-accounting unit. A self-accounting unit is a government department in which the responsibility for the maintenance of the detailed record of expenditure and revenue of ministry/extra-ministerial department or unit is delegated to the accounting officer and where the accounting officer is required to account to the accountant general and total head, or subhead where applicable, at monthly intervals, and also to account to him at the close of each financial year in the manner prescribed by the accountant general. Condition to be fulfilled before a government department may become self-accounting. Before a ministry/extra-ministerial department may be self-accounting, the approval of the accountant general of the federation or state, if state level is being considered, is required before a ministry/extra-ministerial department or unit may become self-accounting. And normally this permission will be given only when a fully constituted internal audit is operating within the ministry/extra-ministerial department or unit concerned. Dimensions of self-accounting. It is essential to let you know that self-accounting is of 4 basic dimensions. These are discussed below. Dimension 1, self-accounting as regards retention of documents. The Director, Finance and Supplies, shall ensure that the following documents in original are retained under adequate security arrangements. Cash books of all sub-accounting officers in original form are retained under his control. vouchers for receipts and payments for which the accounting officer is responsible, other accounting records required by financial regulations and other additional accounting records where appropriate. Dimension 2, self-accounting as regards transactions on behalf of others. Under this dimension of the self-accounting unit, the original documents supporting transaction undertaken on behalf of another ministry/extra-ministerial department or unit will be forwarded by the accounting officer to the accounting officer of that ministry concerned or the accountant general as the case may be, as soon as possible after the close of the month under review. The originals of the documents and duplicates thereof are expected to be forwarded under a covering schedule, in duplicate. Dimension 3, self-accounting as regards receipts of documents. Under this dimension of self-accounting, the self-accounting ministry/extra-ministerial department or unit receiving a schedule of transactions is expected to link the schedule to the relative account total appearing in the current account receivable from the accountant general. Dimension 4, self-accounting as regards payments. A self-accounting ministry/extra-ministerial department or unit will normally make all payments through the sub-accounting officers of the ministry/extra-ministerial department or unit, or through a federal pay officer in the states, where applicable, but whenever this is not practicable, payments within Nigeria or within the scope of overseas offices or agents will be authorized by the issue of a department warrant, among others. Having understood what a self-accounting unit is, we will now proceed to address the meaning of sub-self and non-self-accounting unit or department. Sub-self-accounting unit. A sub-self-accounting unit is a government department in which above-the-line and below-the-line items are recorded and maintained. The permanent secretary or minister, who is the accounting officer, accounts to the accountant general of the federal in subheads and not in details. In the sub-accounting unit, copies of vouchers accompany the subheads aggregates and are remitted to the Treasury on monthly basis. An example of a sub-accounting unit is the Federal Pay Office, usually cited all over the Federation. Non-self-accounting unit. Just as the name depicts, the non-self-accounting unit is not authorized to prepare its own accounts. Rather, documents evidencing all financial transactions in the government units are collated and forwarded to the Treasury. The Treasury, otherwise referred to as the Office of the Accountant General, is charged with the responsibility of preparing accounts for non-self-accounting units. It should be noted that only self-accounting units and sub-self-accounting units are authorized to prepare monthly transcripts, which are forwarded to the Treasury as earlier stated, but with the following supporting documents. I schedule of vouchers pre-listed. 2 certificate of cash and bank balances, and 3 bank reconciliation statement. However, sub-self-accounting units are expected not only to forward the above-listed documents but also an original copy of their cash book and 2 duplicate copies of their vouchers. Summary of Study Session 7. In Study Session 7, please note the following. 1. A self-accounting unit is a government department in which the responsibility for the maintenance of the detailed record of expenditure and revenue of the ministry/extra-ministerial department or unit is delegated to the accounting officer. 2. A sub-self-accounting unit is a government department in which above-the-line and below-the-line items are recorded and maintained. 3. The permanent secretary or minister, who is the accounting officer, accounts to the accountant general of the federal in subheads and not in details. 4. Non-self-accounting unit is not authorized to prepare its own accounts. Rather, documents evidencing all financial transactions in the government units are collated and forwarded to the Treasury. 5. The Treasury, otherwise referred to as the Office of the Accountant General, is charged with the responsibility of preparing accounts for non-self-accounting units. Study Session 8, Pension Fund Accounting. Introduction. There are 2 general types of pension plans. The first requires a stipulated contribution, by an employer, or by a combination of employer and employees, to a pension plan. Payouts from such plans are largely determined by the value of the fund, or the value of an employee's share of the fund. In this study session, you will learn about the operations of pensions in Nigeria generally and specifically the accounting implications of the 2004 Pension Reform Act. Introduction to Pension. Before addressing pension fund accounting, there are some terms you need to understand. These terms as it pertains to pension fund accounting are presented and explained below. 1. Pension. This is a stated allowance to a person in consideration of past services. In other words, it is payment made to one retired from service on account of age, disability, or other cause. It can also be seen as a regular stipend paid by a government to retired public officers, disabled soldiers, the families of soldiers killed in service, or to meritorious authors, or the like. In a nutshell, the pension can be said to be income received upon retirement. 2. Pension Fund Administrator. This is an entity in charge of managing and organizing the fund created by the 2004 pension scheme. Some of the pension fund administrators in Nigeria include First Provident Trust Company Limited, Sigma Vaughan Sterling Pensions Limited, AECO Pension Managers Limited, and IBTC Pension Managers Limited. 3. Pension fund custodians are entities charged with the responsibility of holding pension funds and assets. Pension fund custodians in Nigeria include First Bank plc, Zenith International Bank, United Bank for Africa, and Diamond Bank. 4. Pension plan. This means a formal or informal contract between employers specifying what benefits accrue to employees upon the attainment of specified retirement age. 5. Pensionable service. This may include years of service before, during, and after the introduction of a pension scheme. The 1979 Pension Act. Under this 1979 Act, the qualifying service for pension and gratuity is that the officer must serve for at least 10 years for pension purposes, and 5 years for gratuity purposes. However, the following services are not recognized as pensionable services. 1. Services by infants or officers below the age of 15 years. 2. A dismissed staff or officer, and 3. Officers being absent or on leave without pay, unless such absence was for the purpose of utilizing a scholarship awarded him by the federal or state government. However, certain conditions may lead to part or total loss of pension and gratuity. These conditions include: 1. Misappropriation of funds discovered at the point of retirement. 2. If any employee stays longer than the stipulated years of service or on the attainment of the retirement age, whichever is earlier, the employee will have his entitlements reduced by the number of salaries he received for the period after which he should have retired. The employee is indebted to the employer will lead to deductions of the specific amount from his benefit before payment. 2004 Pension Reform Act. According to Emini et al. 2004, in 2004, due to some problems associated with the successful implementation of the 1979 Pension Act, the Obasanjo regime introduced the Pension Reform Act, 2004. The 2004 Pension Reform Act was signed into law on 25 June 2006. This act is in 14 parts and has implications for accountability in the Nigerian public sector. This new act repeals the 1979 Pension Act and establishes a uniform contributory pension scheme for both the public and private sector in Nigeria with the features of: 1. Contributions of funds by both the employer and the employee to fund retirement benefits. 2. Crediting the employee's retirement savings account with pension fund administrators with any funds so contributed. 3. Pension fund assets are to be privately managed and invested by professional pension fund managers. 4. Strict regulation of the activities of pension fund administrators and custodians of pension fund assets under uniform laws and regulations for both the public and private sectors. And 5. The establishment of the National Pension Commission, NPC, charged with the responsibility for matters relating to the regulation, supervision, and effective administration of the scheme, and for matters connected herewith. Accounting implications of the Reform Act. These accounting implications of the Reform Act are as follows. 1. Issue of accounting for gratuity abolished. 2. Any person who contravenes any provision in the 2004 Pensions Reform Act, shall be liable to a fine, not more than N250,000. That is, the retirement savings account of the contravening officer shall be debited with not more than 250,000 naira fine. 3. Any pension fund administrator or custodian who refuses to render to be commissioned monthly reports of any fraud in its organization shall be liable on conviction to a fine, not less than 10 million naira, while each of the directors 5 million naira. 4. Any person who refuses to produce any book, accounts, document, voucher, or refuses to give any information required by an inspector, shall on conviction be liable to a fine, not more than N200,000. And when the offense continues, to a fine not less than N100,000 for every day the offense continues. 5. Where an employee retires before the age of 50 years, he may request withdrawal of a lump sum of money not more than 25% of the amount standing to the credit of the retirement savings account, provided that such withdrawals shall only be made after 6 months of retirement and the retired employee does not secure another employment. Summary of Study Session 8. In Study Session 8, please note the following. 1. Pension. This is a stated allowance to a person in consideration of past services. In other words, it is payment made to one retired from service on account of age, disability, or other cause. 2. Pension fund administrator is an entity in charge of managing and organizing the fund created by the 2004 pension scheme. 3. Pension fund custodians are entities charged with the responsibility of holding pension funds and assets. 4. Pension plan. This means a formal or informal contract between employers specifying what benefits accrue to employees upon the attainment of specified retirement age. Pensionable service. This may include years of service before, during, and after the introduction of a pension scheme. Study Session 9 Accounting 1. Introduction. The purpose of accounting is to provide a means of recording, reporting, summarizing, and interpreting economic data. In order to do this, an accounting system must be designed. A system design serves the needs of users of accounting information. Once a system has been designed, reports can be issued and decisions based upon these reports are made for various departments. Since everyone in one form or another uses accounting, a good understanding of accounting principles is beneficial to all. In this study session, you will learn about the meaning and nature of auditing in the public sector, the different types of government audits, and the legal framework of auditing in the public sector. Meaning and nature of audit and auditing. Audit and auditing have been variously defined. According to Okolo, 1988, auditing is a conscientious and objective examination into any statement of account relating to money or money worth with the underlying documents, and the physical assets where possible, to enable the auditor to form an opinion on whether or not the statement of account present a true and fair view of whatever it purports to represent. Wolf, 1994. Sees an audit as a process in which the accounts of business entities are scrutinized to enable the auditor to form an opinion as to the truthfulness and fairness of the accounts. Adams, 2005, sees auditing as a process during which the accounting records and the financial statements of an enterprise are examined by independent auditors with the aim of expressing an opinion in accordance with his term of appointment. From the above definitions, it is clear that the emphasis of an audit is the formation of an opinion about the accounts and financial statements of an entity. Types of government audit. This section describes the types of audits that government and its parastatals may conduct. The description is not intended to limit the type of audit that may be arranged. All audits begin with objectives and those objectives determine the types of audits to be conducted. The following types of audits, though not exhaustive, are clearly discernible. Financial audits. This includes an audit of financial statements and financial-related issues. The objective of financial statement audits is to provide reasonable assurance on whether the financial statement of an audited entity presents a true and fair view of the financial position, the cash flows, and the result of operations of the entity. Performance audits. Performance audits basically include the following, among others. I. Efficiency and economy audits. 2. Program audit. 3. Value for money audit. Interim audit. These are audits usually carried out during the year but before the end of the financial year of the entity. An interim audit could consist of several audit visits. The purpose of an interim audit may be primarily to examine the accounting and the internal control system. The auditor can also carry out transaction and balance sheet audits during the period. An interim audit may be on a quarterly or semi-annual basis. They are usually carried out at the instance of the management of an entity, in order to assist them in the preparation of interim financial statements for the purpose of declaring a dividend or meeting the requirements of the stock exchange. The interim audit has the following advantages. 1. It will help to facilitate the completion of the final audit. 2. It is of assistance where the client publishes interim financial statements. 3. It facilitates the early detection of fraud, error, and other irregularities. 4. The attendance of audit staff at intervals imposes a sound moral check on the client's staff. On the other hand, the following disadvantages are attributable to interim audit. A. Already audited figures may be altered after the audit. B. The audit team may lose the trend of events, especially if it is not the same audit team that comes on every occasion. Final, year-end, audit. This is the annual audit, which is carried out at the end of the financial year. It is a completed audit. An annual audit is a regular audit. It is governed by the Constitution for the various tiers of government and by relevant statutes for government corporations. Continuous audit. A continuous audit is one in which the auditor visits the client's offices all year round in the process of obtaining audit evidence, with transactions being audited as they occur and are recorded. The continuous audit has the following advantages. I. It ensures timely completion of the audit. 2. It offered the auditor the opportunity to audit some transactant balances while there is still an audit trail. 3. It assists in the prevention of fraud or their early detection. 4. It imposes a sound moral check on staff. V. Audit staff may be used more effectively. Complete audit. This is an audit in which all aspects of the auditor's examination of the client's records are carried out during one visit. The complete audit is carried out in one or more of the following circumstances. 1. Where the client is small. 2. Where the client suggests that only one visit be made. 3. Where the firm staff prepared the accounts for the client. 4. Where a complete audit is appropriate given the client's year-end data. 5. Where generally it is more convenient, for instance where the client is in a town where the auditor has no office and staff have to travel there. Management audit. This is carried out to assess the effectiveness and efficiency of management. It is a non-statutory audit. It is an independent examination of the quality of the policies of the management of an organization as well as the level of their execution against the background of relevant environmental factors and conditions. It could cover any aspect of the organization's policies and procedures. Management audit has the following advantages. 1. It provides feedback for managers. 2. It discourages unhealthy and fraudulent management practices and procedures. 3. It provides management and board with a report of their performance. 4. It gives the board access to constructive advice. 5. It is usually the basis for organizational turnaround. Internal audit. This is an independent audit of the activities within an organization. It carries out the review of the operations of the entity as a service to management. Internal audit is carried out by an internal auditor who is a staff of the audited organization. It is a managerial control mechanism. Internal auditing is discussed in a later section. Balance sheet audit. A balance sheet audit is geared towards verifying the assets and liabilities of the enterprise in order to obtain audit evidence that these items are fairly stated. The balance sheet is taken as the starting point from where we work, back to the detailed entries in order to substantiate each entry in the balance sheet. System-based audit. The system-based audit is directed towards recording, testing, and evaluation of the internal control system in operation to enable the auditor to determine the extent to which he can place reliance on the control system. Government auditing standards. The government in Nigeria has mainly been interested in legislations, regulations, and executive orders regarding auditing. Much of the provisions in these laws are mainly in the nature of auditing requirements rather than standards in auditing. The government has made auditing laws for the public sector, much of which addressed objectives and procedures of audit of the public sector. This position has prompted the profession of accountancy to intervene in the framework project for public sector auditing. The Public Sector Committee, PSC, of the Institute of Chartered Accountants of Nigeria, ICAN, issued Guideline Number 31 in January 1992, Applicability of International Standards on Auditing, ISAs, to the audit of financial statements of government and non-business public sector entities. The Auditor General, Appointment and Removal 1. Section 86(1) of the 1999 Constitution of the Federal Republic of Nigeria provides for the appointment of the Auditor General of the Federation by the President on the recommendation of the Federal Civil Service Commission subject to confirmation by the Senate. 2. The Auditor General will vacate office in any of the following ways. 1. He has served in the public service for a maximum of 35 years or 2. He has attained the age of 60 years. 3. By Section 87 of the Constitution, an address by the President to the Senate to remove him was supported by a two-thirds majority of the Senate. To be removed in this way, the Auditor General must have become incapable of performing the functions of his office due to 1. Infirmity of mind or body, and 2. Gross misconduct. Functions of the Auditor General. The duties, functions, and powers of the Auditor General are spelled out in Section 85 for the federal government and Sections 125 for the states. They are as follows for the Auditor General of the Federation. 1. To audit and report on the public accounts of the Federation and courts of the Federation. 2. To provide government statutory corporations, commissions, authorities, agencies including all bodies established by the National Assembly with 1. A list of auditors qualified to be appointed by them as external auditors. 2. Guideline on the level of fees to be paid to external auditors. 3. To comment on the annual accounts and auditor report thereon. 3. To conduct periodic checks of all agencies and organs of government including but not limited to statutory corporations, authorities, commissions, agencies including all persons and bodies established by an act of the National Assembly. 4. To submit his reports on the financial statements to each House of the National Assembly within 90 days of receipt of the accountant general's financial statements. 5. By Section 85(3) of the 1999 Constitution, the Auditor General of the Federation has no authority to act as external auditor to government statutory corporations, commissions, authorities, agencies, etc. Summary of Study Session 9. In Study Session 9, please note the following. 1. Auditing is a conscientious and objective examination into any statement of account relating to money or money worth with the underlying documents, and the physical assets where possible, to enable the auditor to form an opinion on whether or not the statement of account is present a true and fair view of whatever it purports to represent. 2. All audits begin with objectives and those objectives determine the types of audit to be conducted. 3. Under the present democratic setting in Nigeria, the Constitution is the supreme law from which all other laws derive their existence. Section 85(2) of the 1999 Constitution vests the power to audit the accounts of the Federation and of all offices and courts of the Federation on the Auditor General of the Federation. 4. The government in Nigeria has mainly been interested in legislations, regulations, and executive orders regarding auditing. Much of the provisions in these laws are mainly in the nature of auditing requirements rather than standards in auditing. Study Session 10, Audit of Government Accounts 2. Introduction. Government accounting is guided by the Constitution and financial regulations of a nation. It is concerned with the recording of the mobilization and prudent utilization of the finances of a country. In this study session, you will learn about the Auditor General at both the federal, state, and local government levels including their functions as the procedures for appointing and removing them. The session also discusses the Public Accounts Committee, PAC, and the independence of the audit function. The Government Internal Auditor. There is no express provision for the internal auditor in the Constitution. However, it is provided for in other subsidiary legislation. The Financial Regulations, 2007, provides in Chapter 20 for the internal audit functions. Section 2001 of the Financial Regulations requires that the accounting officer of a ministry or extra-ministerial department shall ensure that an internal audit unit is established in the ministry. The functions of an internal auditor under the Financial Regulations are: 1. To carry out a continuous and complete audit of the records and accounts of revenue and expenditure, plans, and store. 2. To carry out management audits encompassing other areas of activities and functions of a ministry/extra-ministerial department. 3. To carry out a comprehensive audit of all the operations and activities of the ministry/extra-ministerial department. 4. To ensure that safeguards introduced for the prevention or detection of fraud and loss of cash are adequate. 5. To ensure that the system of control for the collection of revenue is adequate and that all money received has been brought promptly to the account, to the correct head and subhead. Appointment of an internal auditor. There are no special provisions for the appointment of an internal auditor. He is a civil servant who has been appointed and deployed to the ministry in accordance with the civil service rules. However, Section 2002 of the Financial Regulation enjoins the accounting officer of the ministry to ensure that the internal audit unit of the ministry is placed directly under the control of a competent accounts officer trained in treasury duties by the officer of the Accountant General. The Public Accounts Committee, PAC. The Public Accounts Committee is a committee of the National Assembly that is responsible for the consideration of the Auditor General of the Federation. Each state legislature also has a Public Accounts Committee. The Constitution enjoins the Auditor General to submit its annual report to the legislature, which in turn passes it to the Public Accounts Committee. The committee examines the public accounts on the basis of the observations raised in the Auditor General's report. Functions of the Public Accounts Committee. The following are the functions of the Public Accounts Committee. 1. To deliberate on the Auditor General's annual report submitted to the legislature. 2. To summon the appropriate accounting officer to appear before the committee to give an explanation on the observations raised by the Auditor General. 3. To examine any officer on oath, if need be. 4. To recommend to the executive any action to be taken against an offending officer. 5. To deliberate on other matters relating to the management of public funds. Auditing in the local government. The audit of local government councils is provided for in the Model Financial Memoranda for Local Governments. The memoranda make provision for both external and internal auditing. External internal auditing is carried out by the state's Auditor General for the local government of that state, while an internal audit department in each local government council handles the internal audit. Auditor General for local government. According to the provisions of the financial memoranda, there shall be established in each state the office of Auditor General to be appointed by the governor of the state. The following are the functions and powers of the Auditor General for local government. 1. Power to carry out the audit of accounts of all the local government councils in the state on a regular basis. 2. Power sanction and surcharge any officer as specified in the financial memoranda. 3. Power to function as the chairman of the local government audit alarm committee. 4. To notify the Public Accounts Committee and the local government audit alarm committee on issues relating to serious audit queries for which the accounting officer of the local government is liable and other alarms of significant importance. 5. Inform both the Public Accounts Committee, the local government chairman, and the governor in writing where a local government accounting officer does not respond within the stipulated time to a query that affects his office. Summary of Study Session 10. In Study Session 10, please note the following. 1. There is no express provision for the internal auditor in the Constitution. However, it is provided for in other subsidiary legislation. 2. Section 2001 of the Financial Regulations requires that the accounting officer of a ministry or extra-ministerial department shall ensure that an internal audit unit is established in the ministry. 3. The Public Accounts Committee is a committee of the National Assembly that is responsible for the consideration of the Auditor General of the Federation. Each state legislature also has a Public Accounts Committee. 4. The Constitution enjoins the Auditor General to submit its annual report to the legislature, which in turn passes it to the Public Accounts Committee. 5. The committee examines the public accounts on the basis of the observations raised in the Auditor General's report.